Queens of the DMV. I'm your co-host, Cher Castillo, here with my other co-hosts, Arnita Greene and Arial Pegues. As always, you can tune in every Tuesday to the Queens of the DMV on Spotify, YouTube, and Apple Podcast at 5 p.m. Thursdays. Today, we have our special guest, Leo from Draper and Kramer, back again to visit us.
Ladies, well, thank you for having me back. I can't believe I made it to the second round of the Queens of DMV. Season two is official.
I know.
So for those of you who didn't catch you last time, Leo, tell the audience a little bit about yourself and what you do.
Yeah, so I've been in the mortgage business for 19 years now, and we serve in the DC metropolitan area. My team and I are a group of 11 people that service all of our real estate agent partners. We specialize in purchase transactions. We work with a lot of real estate agents, financial advisors in the area, and we've grown a pretty good business over the last few years. So I'm glad to be back here, impart some knowledge not only to your listeners, but obviously, hopefully, to all of us, right? So I'm excited to be back.
Awesome. And where can the audience find you on social media?
Yeah, you can find me at Leo Anzoleaga Group. That's LeoAnzoleaga Group on Instagram. Leo Anzoleaga Group would be the handle.
Awesome. Well, Leo, we asked you, because you're the expert, to come here today to talk to us about how to navigate rising interest rates and still purchase your dream home. As you can imagine, as agents, that's a big question that we've recently been getting, like, well, should I still buy a house? The interest rates are going up. And of course, our answer is always going to be yes. But we want a less biased opinion. I mean, you're in the mortgage industry, you're seeing interest rates go up. So tell us a little bit about what you're seeing.
Yeah, well, I think that's a valid question. Obviously, it's specifically in this time that we're living in today, like where inflation has kind of taken, kind of the headlight or the headlight in this entire market, which is bringing interest rates up. But I think I said this in our last conversation, and I stand true to it, right? People, you buy a house when you're ready to buy a house, right? So regardless of whatever interest rates are doing, regardless of whatever the market is doing, you buy a house when you're ready to buy a house. And oftentimes people say, well, what? How do you know, right? Well, I mean, we talked about the actual space, the concept of space that a lot of people have kind of maybe have understood a lot better over the last few years. Rents going up. I mean, last report shows rents that were up almost 16% in some areas, or 7%, I think, nationwide, right? So, but ultimately, you do when you buy. And I think the second piece of that is context, right? What we're talking to our buyers right now is context is everything, right? So, for us to see interest rates in the low twos, during the pandemic and obviously into 2021. Was really an anomaly. I mean, if you really think about it, we have never seen rates this low ever in terms of the history of interest rates, right? Before the liquidity crisis in 2006, I mean, rates were hovering, in the high sixes, right? So for us to be anywhere in the high fours, low fives, it's still an anomaly, right? But certainly nowhere near, where we were, during the pandemic, right? Now, I do believe that buying real estate is the greatest hedge against inflation. And long term, I mean, statistics show that it's the greatest way to build wealth, right? And so, but you buy a house when you're ready to buy a house, regardless of what rates are doing. And I think to your point, I would encourage people when they're ready, to definitely invest in real estate.
No, I definitely agree.
So have you seen a slowdown in files coming in since interest rates started going up?
Yeah, I mean, I think to a little bit of that maybe a couple of weeks ago or so, right? Especially when we started to see rates go from the mid fours into the high fours, low fives, right? But a lot more activity this past week, right? I think it's interesting to me how people make decisions in general. So like some authors would say that people make decisions emotionally and justify things logically, right? I mean, how many times have we bought for you ladies, a purse, and you're like, man, I should.
No, don't go there.
But it's a good investment. It's a good investment, right? It's a good
You're
investment.
right. You're right.
Right? It's a good investment. But the moment we walk away from the store, we're like, we have buyer's remorse, right? So like, in the same way, I think, a crowd follows a crowd, right? And so fear, like, a lack of information, I would argue, is what caused some of these buyers to kind of get off the fence. I mean, a lot of them have been losing left and right because of how competitive the market has been. But a lot of them are coming back. And I would argue that is going to continue, at least for the next 2 to 3 years. And there's some very specific stats tied to that. But yeah, I have seen a little bit of a slowdown, but it's definitely picked back up.
Yeah. It's interesting because I've actually seen a little bit of a pickup because I feel like some buyers that were being very slow have decided that it's time to pull the trigger because they don't want to wait until the interest rates go up again.
Mhm.
So, I've been seeing some of that versus what I thought I was going to see a bit more of a slowdown. I've seen a bit of an uptick.
I think the season has something to do with it too, Cher, because typically spring, summer, people start coming out and getting into the market around this time anyway. So I think it's probably a mixture of both of those things.
Yeah. So for higher interest rates for the market, I mean, what does that mean to you, Leo?
To me,
Mm-hmm.
I mean, I think, well, if I could just maybe push back and say to a consumer, it means more expense, right? It's a more expensive, asset, right? And understandably so, right? So when you have a mortgage payment that was, call it $1,000, now we're paying $1,500 for that same mortgage. It's an added expense, and so people, as understandably so, as they budget for, their expenses every month, they say, "Gosh, a $500 increase is a lot for me to swallow," right? For me, I mean, I think context is everything, right? Like, and I keep saying that one word because I remember, I mean, I've been doing this for 19 years. I look like a 19-year-old, but I've been doing this for a while, right? Like, um, I remember when rates were at 6.875. You know what I mean? Like,
That's
I
when I bought my first house.
right? Like,
Yep.
our parents, bought properties in the double digits, right? And so, like, I think context is everything. And yes, we have not seen rates this high since 2009. I do believe that rates will come back down in the first quarter of next year. We're not done yet. I think rates are going to continue to go up, get closer to the 6% mark by the third quarter of this year. But we're going to definitely see, I believe, a turn at some point at the beginning of the year. And what is that going to do for home prices? Well, I mean, more people are going to get off the fence, right? And more people are going to go and buy properties, and that's going to continue to push prices up. The last thing I'll say about that is this: there is a dynamic tension in my mind between an interest rate, right, versus appreciation, right? In certain jurisdictions, appreciation rates over the last year or so, I mean, we're looking 6%, 7% appreciation in some counties, up to like 9% year over year, right? Like, so yes, you might actually buy an asset now, a property now at 5.5, right? But it might actually appreciate 10%,
More.
by this time next year, right? So which one is it? Which one are we looking into? And so that's kind of the how I approach, how I look at, interest rates increasing in this market.
Definitely. How does the buyer choose a right lender in this market?
Yeah. I think ultimately you work with whom you feel most comfortable with
Right.
at the end of the day, right? Like, I think endorsements are important, referrals are okay, but endorsements are important. Similar to a financial advisor. A financial advisor, when he or she endorses a service provider, real estate agent, lenders, insurance agents, etc., he is essentially giving their endorsement or sticking their neck out for that provider. Accountability is key, right? So, and that's obviously tied to that endorsement. Um, a reputation is important, right? But at the end of the day, you work with whom you feel most comfortable with. Now, I think tenure has something to do with this, but I would also say advice. So most consumers, when they look at a mortgage, they typically think about two things. They think about the rate and they think about the payment. And that's not a bad way to look at this. It's just simply incomplete, right? Because we don't just live on the rate and the payment. The other half of that equation is actually cost. What is this loan going to look like in 5 to 8 years, 9 to 14 years? So to us, rate and payment are important, but the advice is extremely important, right? The advice in terms of the overall asset that you have that you're buying. So, but at the end of the day, you work with whom you feel most comfortable with. That's usually tied to the endorsements that you find ladies obviously give, because there's accountability there in this marketplace. And I think being local also plays a massive role. I mean, Cher knows where I live, right? So like she can literally come knock on my house if something were to go wrong. But yes, those are the key things that I think about right off the top of my head.
Yeah, the last point that you said, local, it's really important to me. So, I really do appreciate you saying that. A lot of people are getting these loans from all over the place, and the lenders are not coming through. So that one hit home for me right there.
Yeah, and understanding the local market, right? Like it may not be a big deal to have a quick close in other markets, but a market like DC, Maryland, and Virginia where it's super competitive, and having that advantage where you can have super low contingency days with specific lenders, or really quick closes, that truly helps. I mean, I know for me, in the last super competitive situations that I've had, that that was the winning ticket, to be able to close within 10 to 14 days, whereas other lenders, are not necessarily able to do that. And then even if you do have an appraisal contingency, which, there's barely any contingencies anymore, but if you are, that it's a very low number of days to get an appraisal, like 3 to 5 days. A lot of lenders can't do that.
Mm-hmm. Yeah, and I think also, if I can just piggyback and cement one point, I think ultimately strategy plays a role here, right? So like it's the little things that win. And I don't blame consumers, honestly, like because to them, unless we articulate our value correctly, we're just a commodity if we're honest, right? It's on us, it's on me, it's on my team to be able to articulate the value proposition correctly. And at the end of the day, it's advice, right? We want to become the Sherpas in this entire journey. But little things like property inspection waivers, right? How does that play a role in a competitive market where we're escalating up and we're waiving appraisals? That stuff matters, right? Like appraisal gap strategies, right? Like I wrote a piece in the Washington Post this past 2 Sundays ago about this, right? Like appraisal gap strategies are a real thing today, right? Consumers don't just want to hear you're going to have to escalate up. That's just the market. They're going to want to understand, what's my break even point? When am I going to receive my money back? What does that look like in terms of overall cost? So advice is very, very important in this marketplace. And I think we just need to do a better job of giving my industry, that is, giving the consumers advice.
Well, I mean, it's
Go
actually,
ahead.
sorry, Ariel, I just wanted to say one thing. It's actually not just your job, though. It's actually our jobs as agents to be able to
Mm-hmm.
articulate the value in using the right lender as well. Because I just had that conversation with a potential new client yesterday who's thinking about switching over to a new agent. And they're like, well, why didn't my agent tell me about using a competitive lender that can close quickly? I'm like, I don't know why your agent didn't tell you that, but that's super important because the market is moving that quickly. And
Mm-hmm.
for us, if we don't have those alliances with the right type of lenders, then we're doing a disadvantage to our clients.
Right.
Correct.
I was literally going to say the same thing. But I think a part of that too. And Leo, you mentioned advice. So I had, a lender speak to a buyer, and they were going to, work with them moving forward to do a pre-approval. But one thing that stood out in that conversation is that the lender told the buyer that the market is volatile, and it kind of scared them. So my question to you is like, how do you talk to your clients or the folks that you're working with about the market? How do you educate them? And do you feel like the market is volatile right now?
Yeah, great question. So I think one of the best principles when you talk to consumers is not to use inside terms outside, right? You know, volatility is a financial term, right? So the markets, the secondary market is constantly moving, right? Volatility, right? And rates are obviously determined by how these instruments perform. So a lot of consumers think that rates are driven primarily by how banks compete for their business, but that's not the case. Rates are determined by how mortgage-backed securities trade. So if there's a buying pressure on bonds, rates come down. If there's a selling pressure on bonds, rates go up, right? And so volatility does exist in the secondary market as it pertains to rates, right? They're constantly obviously moving. But I think communicating to a consumer, and not in simple terms that they can understand, but in actual real terms is extremely important. External terms, right? So one of the things that we talk about in our initial conversations with them is the why, right? Why do you want to do this, right? Why are you looking to invest in the property, right? Oftentimes it's because they're getting married and they have an expansion of family, right? Oftentimes it's because they're tired of renting, right? And so ultimately it's making sure to help them focus on their why, and then use terminologies like, hey, historical data shows that even though rates are going up, volatility, right? It's still a good time to buy, and here's why, right? Stories sell, but facts do tell the story, right? So when you show them the numbers, the information, and you use terms that are not internal to our industry but external, I think that the numbers really speak for themselves. So I think we do a pretty good job. I think when we present options to consumers, to make it um, as external as possible and not utilize things that we obviously know. I don't know. Does that answer your question?
No, that was right on.
Absolutely. It was right on target.
Yeah.
So I was gonna say, what guidance would you give the buyers out now, in a competitive market versus a stable market?
Meaning in terms of like competitive, as in like housing prices, like
Yes,
escalations, etc. Yeah.
exactly.
It really does go back to your why. Why, like the answer is, why do you want to do? So there's a great book by this author. His name is Todd Duncan. He talks about high trust selling, right? Like most people, like when they look at any type of investment, they usually think about the first two layers of this pyramid, right? But it's the very bottom of the pyramid, the actual why, right? That drives decisions, right? And so once we do a good job of understanding the why behind their investment, the guidance is pretty easy at that point, right? And so think about it like this: like when you go to a really, really, really high end restaurant, right? They almost like know everything about you before you come into the store, right? To the restaurant, right? And it's because they've done their research. They understand what's important to you and why you're obviously visiting. In the same way, my first advice would be is really understanding your why. And then the second, the how, in terms of navigating this market. I love this quote by an agent that I know. He always used to say, in this market, you're going to write offers the same way you're going to take showers. You're going to have to do it every day until you find the property that fits, right? Like, and so I love that, because that mentality is essentially saying, hey, look, it might take 5 or 6 properties or 7 properties before we find the right one for you. But once we do, just know that as long as you obviously stay in this property for a period of time, 5 years is typically the number, you will see a return. Here are the facts. Here are the numbers, right? And so I think guidance is really tied to the why, the how. So I really, really would focus on their motivation.
A lot of people aren't motivated enough. Sorry, I'm talking low. I think sometimes people are just not motivated enough. They want it, but some people they see, okay, 1 or 2 deal offers they get beat out of, and then they're already stressed out. So it's our job to let them know that it's just the market that we're in. Just like you said, we might not get the first, second, third house, but look, if you stick in this, you're going to get the house. We're going to get you.
Yeah, but also, like, I think it's important to also note and acknowledge the fact that a lot of first-time home buyers are entering the marketplace for the very first time, right?
Yeah.
So here's a stat, right? In the 1980s, there was a boom of births. In other words, a lot of people were born in the 1980s, right? And all of those people are entering the marketplace for the very first time. They've held out for a longer period of time to buy a house. Why? Because they've seen their parents struggle, right? Like they're like, I'm never gonna do that, right? Like they've seen their parents go through short sales, foreclosures in the past, right? Right. And they vow, they're like, I am not going to make this. I don't care if it takes me 10 years. I don't care if I live with my parents for an additional 3 years. I'm not making that mistake. Right. And I think they just need a little bit of education from us, right? And saying, hey, look, you buy a house when you're ready to buy a house, but this is a really, really good investment long term. Now, if you tell me, hey, I'm going to buy this house and I'm going to flip it in the next 5 months, unless you're working with the flip queen of DC, right? Like, and you have a good portfolio there, it's a different story. But like, I mean, as long as you hold on to this property, you're going to see a return. So, average appreciation over the last 63 years in the DMV is 4.63%. The last 63 years, right?
Per
So
year.
per year, yeah, average, right? Over 63 years. Projected in DC in certain markets, let me see, in the 2001 market, the District of Columbia, this is just a quick number, okay? The appreciation projected is 6.22%. Cumulative in the next 5 years is 23.99, right?
Wow.
So you will see a return on your investment, Mr. Buyer. But again, it's tied to your right. Why do you want to do this? You know what I mean? Mm-hmm.
I think another thing that plays a factor into these stats and the things that we're talking about now is financial literacy. You know, back when our parents were purchasing and those different things, like what we have access to now versus what they had access to there's a huge margin. And I also think like your decision making can also be based on financial literacy and knowing what real estate can do for you in the long run, regardless of what the market is doing and what you're purchasing.
Yeah, and I think that's a great point, and I think it goes back to the original question about how do you choose, in my case, a lender, right? Like, um, it's gotten very competitive in this marketplace, right? And oftentimes, what I talk about is advice. You're looking for an advisor, okay? Like similar to a financial advisor, you need someone that's gonna manage the other side of the liability, okay? So, in other words, someone that's gonna help you manage this liability for 20 years, 15 years, 20 years. Advice absolutely matters. Financial literacy absolutely matters, but you ultimately need a guide, right? So, rate and payment are not always the best strategy. Okay,
Right.
mortgage insurance on a monthly basis is actually a really, really good strategy compared to single premiums, right? In other words, paying the entire mortgage up front, mortgage insurance up front, right? Why? Because of appreciations. But little things like that matter, and I think most people are. There's a lot of information online, but very few resources that can kind of help you and guide you through what does that mean for me and my overall why.
Right.
So, Leo, what do you say to buyers that are super concerned about the bubble busting? You know, everyone keeps
Yeah.
talking about that. We haven't seen the bubble burst in a while. You know, it's coming up. It's coming up. It's been coming up for a while, but it hasn't come. So, how do you manage that question as, you know, your clients ask you that?
Yeah. So what happened in the liquidity crisis has a lot to do with equity positions, right? So when you have mortgage products that essentially were allowing you to put as little as 0% down and amortize negatively over a period of time, a lot of people just didn't have a lot to lose, right? And so understandably so. So when the markets collapsed, they're like, hey, you know what? I'm just going to walk away from this, right? The equity positions that we have right now, I mean, look at our own houses, your own homes, right? Like, I mean, it's going to be very hard for people to walk away from 15, 20, 30% equity in their homes. So that the myth of the bubble, or the concern of the bubble is probably the better way to put it. There's not a lot of facts behind it, right? Primarily because lending has tightened over the last few years. I mean, it's definitely harder to buy a loan. I mean, when is the last time you bought a property? I mean, they essentially ask for like a DNA sample, right? And then your W-2s, right? Like, I mean, right? I mean, so there's a lot of verification here. No more Nina loans, no more, stated income asset loans, stated income loans. But then the equity position that we're seeing in our markets is the other reason why.
Yeah, it's going to be hard to leave your house when you know you have all that equity in it.
Yeah, but can I maybe one more point on that? So you just kind of trigger something, Arnita. So the question then, a lot of also consumers, a secondary question would be like, well, why are prices just going up? Well, they're going up because A, you have first-time home buyers entering the marketplace for the very first time, right? B, you have a lack of supply. So developers are not able to keep up with demand of household formations, right? So in DC, for example, okay, household formations in DC are 15,250, okay? The actual homes being built right now are 38, 31. We're not even keeping up with demand, right? In other markets, you're like at 500, right? Versus, the 5,000 household formations that are being formed, right? So that's the second piece as well that's contributing to escalations, properties that are going up, right? Are we going to maybe see a little bit of a dip in terms of like how many properties, how competitive this market is? Maybe, but I would argue for the next 2 to 3 years, this is going to be the norm.
Mm-hmm.
Well, thank you so much, Leo, for joining the Queens of the DMV again. We're so happy for you to share all that information with us. We always learn something new. So I'm going to share all these stats with my clients moving forward on appreciation. Thank you. And as always, tune in, audience, every Thursday at 5 p.m. to the Queens of the DMV on Spotify, YouTube, and Apple Podcasts. Thanks again. This is Cher Castillo, your co-host, signing off with my co-hosts Arnita Greene and Arial Pegues. Until next time.
Thanks, Leo.
Thank you.
Bye.